My name is Jake, welcome to the channel. In today's video, we're going to be doing another Review My Pie video where I review 6 subscriber portfolios. I'm going to timestamp them all in the description below, so if you want to go back and forth between the portfolios and see which ones are interesting to you, you can go ahead and check that out. Please keep in mind, I'm not a financial advisor, so everything that I'm sharing here in the video are just merely my opinion and that they should not be taken as financial advice. If you follow my channel, I originally started my channel to help new or beginner investors learn about dividend growth investing. The Review My Pie series here is fairly new on my channel. I started doing this a little over about 2 months ago, and I've received a lot of positive feedback from the community here, and I'm going to continue doing Review My Pie videos in the future. What I've done so far is about every 2 or 3 videos, I'm going to try to do a Review My Pie. And a lot of you have submitted your portfolios via email. And I just want to let you know, if you've submitted your portfolio, I have it in my inbox. I haven't forgotten you. And if you would like me to review your portfolio in a future video, shoot me over an email and add a little bit of context to who you are, right? So that I can add my opinions to the portfolio and kind of make it as relevant as possible for you. So when I'm talking about context, I'm really talking about what is your age, what are your goals? A goal could be you're looking to retire or tap into your dividends in 10, 15, 20 years. That helps significantly because then I can add a little bit more perspective into the target allocation of your portfolio, as well as the type of holdings that you have in your portfolio. So if you can send that over to me, that and little pieces of information, also as well, like how much you're adding to the portfolio every single week or every single month is incredibly helpful. Before I dive into the 6 portfolios here in today's video, I want to give everyone, if this is the first video that you're watching on my channel, I want to give you a quick snapshot of who I am as an investor. I'm in my mid-30s. And I'm looking to achieve financial independence and retire early in the next conservatively 10 to 15 years. And I'm looking to retire off of my dividends where I'm living off of the dividends and not selling off of the shares or liquidating my shares. Traditionally, if you're seeking financial independence or looking to retire early, the goal there is to have about 25 times your annual expenses. And what I'm trying to do is to have the dividends in my portfolio 100% paid for my living expenses and some, right? And so that's kind of the mentality, the perspective that I have. And I've been investing for over 10 years in many different strategies. I've made a ton of money. I've lost a ton of money. It's definitely been a learning curve for myself in terms of what's worked and what hasn't worked. And what I've decided for me personally is slow and steady wins the race, and that's the investing strategy or the approach that I have when investing. When reviewing the pies, I'm seeing them for the very first time. So when I pull them up here, I have not already pre-scripted what I'm going to say. This is as live as it can be without live streaming the video, I guess you could say. So let's go ahead and let's dive into the very first portfolio. Okay, let's take a look at the first portfolio. The first one is going to be from Jeremy. Jeremy writes, "Hey Jake, I've really enjoyed your show and have learned a lot. My wife and I have 401ks through our jobs, and we're also maxing out our Roth IRAs, so our retirement will be set. I'm 35 and she is 30. And so we just became completely debt-free and want to invest an additional $2,000 per month in a taxable account. My plan was dividend growth investing through an M1 Pie, but I've read so much about the tax drag on the dividends, especially having a 4% yield. Warren Buffett, even talks about that, stating that he doesn't pay dividends to shareholders through Berkshire because their dividend would turn into less than $1 and he can turn it into more than $1. Some say to sell shares rather than to collect dividends in early retirement, or to sell out of growth and buy high yield stocks when you're ready for the passive income. I thought dividend growth investing was the way to go and was ready to fully unleash on this strategy, but this tax deal has me confused. Not to mention the REIT and bond being taxed at normal tax rates instead of the qualified dividend rate. Any help or advice would be appreciated." Well, first off, Jeremy, thank you so much for the kind words. It looks like you're focused really heavily on the tax implications of your investments. It looks like you're doing the right thing with investing in your tax advantage accounts, your 401k and your Roth IRA. It looks like you're now starting to invest in a taxable account. I really like the fact that you're doing this because you're going to be able to tap into these investments sooner, because there's restrictions on your advantaged accounts where you're only able to leverage them or tap into them once you reach 59 and a half. And I don't know what your ultimate goal is if you're looking to retire in 10, 15, or 20 years. I'm going to make the assumption that you're looking to retire in 20 years. Okay. And so you're looking to retire in your early mid 50s. Okay, so you want to definitely make sure that you're still investing into a taxable account. And this is one of the reasons why I focus on growth versus current yield. Okay, so the example of your investments are currently yielding 4%. We'll look at your portfolio here in a second. The tax implications definitely play a role in my decision making when investing. For example, I would much rather invest in Visa, for example, that's increasing its dividend 25% year over year, instead of Chevron, as an example, that's yielding over 4%, but growing much slower, right? And so that's my investing approach. However, I'm not just investing in a Visa, right? So investing into, I don't know, the S&P 500, for example, which traditionally grows between 9 and 11%, or grows its dividend, the compounding annual growth rate of around 10%. That's kind of my sweet spot in my age, right? Now, if you're in your 20s, that would be fundamentally different. Now, and also if you were in your 50s, that would be different. Let's say, for example, you were in your mid 50s, I would say keep the 4%, keep it. Because your wife is in her 30s, your mid 30s, I would say skew more towards the side of growth. Okay, when it comes to you're absolutely right when you mention here with the REITs and the bonds being taxed differently. That's why I also lower my exposure to REITs, but I'm also not in the highest tax bracket. It's important that you understand the different tax brackets, your goals. I shared an entire video on how dividends are taxed. You can check out for you or somebody watching the video that are unsure of how dividends are taxed. You can check that video out. I personally don't believe that. In my particular situation where I'm paying a 24% current, income tax rate on ordinary income, for me, it's not so discouraging where I'm not going to invest altogether in REITs. That's my personal opinion. However, I do have a more allocation towards my qualified dividends, for example, companies that pay a qualified dividend. What I'm getting at is the 4%, in my opinion, you're gonna pay more in taxes along the way, and you're gonna suffer in growth if you're looking to retire in the next 15 or 20 years. So if you were looking to retire in the next 5 years, I'd say you're spot on, keep doing what you're doing. If you're looking to retire in 15 plus years, in my opinion, you would be better served with going after investments that are growing their dividend quicker and perhaps are paying a smaller current dividend today, but that compounding, that snowball effect will then take place. You'll pay less taxes today. You'll also grow your dividend faster. And that break-even point, I'd have to pull up my calculator, but that break-even point, if you're focusing more on growth instead of current yield, it'll take a little bit time for the growth to catch up. But once it does, that snowball effect will take over and you'll see much greater results with the dividend growth, assuming that you're looking to retire in 15 or 20 years. When talking about Warren Buffett, you're absolutely right. Berkshire does not pay a dividend. The reasoning behind this is Berkshire, or Warren, believes that Berkshire is better off as a company, and shareholders are better off with Warren Buffett creating shareholder value through reinvesting their cash flow into their business. It's one of the reasons why you see so many commercials for Geico. Save 15% or more on your car insurance. That's Geico, right? Owned by Berkshire. They invest into marketing. They add more to their marketing spend, and they generate more for shareholders in that way. At least that's their management approach in driving shareholder value. So let's go ahead and let's take a look at your portfolio. All right. So it looks like over the last 5 years, you're up 72%. This is not factoring in the reinvestment of dividends. You're at just under 3% dividend yield. This has been a couple of weeks since you've sent this over, and the market has just skyrocketed since then. So your dividend yield has gone down in an entire percentage point. So something to factor in there. You have a broken down: consumers 17, technology 15, healthcare 15, financials 13, all the way down to telecom. Bonds 5%. I like that you only have 5% in here. Me personally, I'm 34, and I don't have any exposure to bonds, zero exposure to bonds. The only reason why I would ever have bonds is to rebalance. Say the market drops another 20%, then I would rebalance, sell everything out of bonds, and then put everything into equities. Other than that, I personally wouldn't own bonds. Real estate, only 10%. Okay, so let's take a look at some of the holdings that you have in here. You have 11 holdings in consumers. They're all equally weighted. Pepsi, Lowe's, Home Depot, Costco, Disney. These are really great dividend companies. Dollar General, very recession-proof. McDonald's, Comcast. Comcast, I really wouldn't classify as consumer. In my opinion, this would be more telecom. But nonetheless, great companies in here. Technology, you got 7 in here, Microsoft, Apple, Texas Instruments. Yeah, these are all great. I also like the target allocation. It's fairly distributed. Really good. Accenture, does Accenture pay a dividend? They do pay a dividend. Okay. All right, great. Healthcare, Johnson & Johnson. The reason why with Accenture, I used to work with Accenture they used to work with one of the companies that I was at, and I didn't know that they paid a dividend. That's kind of cool. Johnson & Johnson, AbbVie, United Healthcare, Merck, MDT, CVS, really good. These are all great companies. So it looks like you're looking more at large cap companies, more established blue chip companies. Industrial, Union Pacific, Lockheed Martin, ADP, Raytheon, really good. The only one, if you follow the channel, this is my favorite industrial company, 3M and Waste Management, my favorite industrials. Real estate, you got Realty Income Store, Welltower, LTC, Simon Group. So you're very skewed towards retail. In my opinion, I would look more into growth sectors like cell towers, like AMT, or data centers like DLR. You could also look at industrials. I really, really like industrials with PLD, with Prologis, really hyper growth real estate REITs. They don't pay like a 4 or 5% current yield. They pay more of like a 1 or a 2% dividend yield. But like I said, they're growing their dividend, in some cases 15, 20%. Okay, utilities, 4 of them. NextEra Energy, great. Dominion, Southern Duke, very good. Bonds, what do you got in here? Okay, great. BNDX, so both from Vanguard, good. Telecom, Verizon, and AT&T, yeah, great. I mean, these are really good. So you got 53 holdings in here. I really like your portfolio. There aren't any companies in here where I was like scratching my head, okay, are these companies going to go bankrupt? I think these are really high quality companies. Thank you so much, Jeremy, for sharing. Ross writes, great content. It's hard to find quality opinions out there regarding dividend growth over yield. Well, hey, Ross, thank you so much. I really appreciate you saying that. I'm 33, going for a long-term and maintainable portfolio. I'm trying to decide if I should pull the trigger on M1 for the pies or wait to see if Fidelity goes something more with fractional shares in regards to automation. Fingers crossed. I would describe my goals for the portfolio as a dividend growth portfolio that's not shy about dipping into growth where the total returns make sense. I'm skipping bonds until I'm a bit closer to retirement. I need the extra growth to catch up. I'm sticking to more than 23 stocks with some ETFs for diversification and international exposure. I'd appreciate any feedback, but the international exposure is where I have questions for you. I have VX US at 15%. I know 20 to 30% is usually recommended for greater diversification. However, with foreign markets historically having such low returns, it's hard to convince myself to go any higher than 15%. Any thoughts would be much appreciated. Well, Ross, first off, thank you so much for the kind words. I really appreciate you sending this over. These are really great questions. So first off, let's talk about Fidelity and M1. When it comes to brokerages, if you're comfortable using Fidelity, and I think the trend is going towards fractional shares. I think, honestly, I'd have to check and see if Fidelity doesn't already offer them. I think they do. Someone in the comment section, let me know. I'm pretty sure that they do. But when it comes to that, if you're comfortable using Fidelity, stick with Fidelity. I've used Fidelity for my employer 401k. I think they have great customer service. I know a lot of people absolutely love using Fidelity. For me personally, I use M1 Finance for my dividend growth portfolio here, which I share on YouTube, but I also have a Vanguard account. I use Vanguard as well. When talking about your goals, so you're looking at dividend growth, you're also looking at, the growth, like actual growth as well, which I think is really, really important. 33 years old, you're not old. Man, you're not old at all. You're as old as I am, right? So maybe you started a little bit later. But that means if you're looking to achieve financial independence, or you're looking to invest so that you, I think majority of people, when they're investing, they're following my channel, you're trying to achieve financial independence. I mean, that's what it's all about, right? And so 33 is not too old. You definitely have time. If you hustle, you could retire in 10 years, easy. Now, going down here, when talking about international exposure, I think there's a lot of mixed information when it comes to international. I think a lot of people have different opinions. So in my opinion, if you follow other people like Dave Ramsey always talks about diversification. He always says, okay, you have to have 20 or 30% international. I don't agree with that at all. I don't agree. Now, for example, with investing in international, there comes also a lot of risk that is not talked about. You have the currency risk, right? These other companies, these international companies like Nestle, they're great companies. There's other great companies in other countries, but the challenge is, you're purchasing them on the exchange here in the US. These other companies internationally are not always held. And I'm US, so I'm obviously biased. I used to live abroad in Europe, so I understand that in America, we don't do everything better than other countries. I want to put that out there. However, I do want to say when it comes to the auditing process of US-based companies, in a lot of cases, it's much more strict than in other companies. So, and we're seeing that a lot right now with companies from Asia. Right. So I don't want to single out any countries or anything, but I do know that that's a hot topic right now. So for me, there's also that added risk of the unknown. And that's why I prefer US-based companies more over international companies. Also, there's tax implications that come into that, right? As a US resident or, US citizen that's, able to purchase companies here in the US, there's a lot of advantages that we have. I will say that. So however, I do personally own VXUS in my Roth 401k. I currently do own that. I only have 10% allocated to it, and I'm starting to feel that's almost too much for me personally. I would much rather invest into VTI, the total stock market fund from Vanguard, and that's just my opinion. Now, the reason why I would much prefer the S&P 500 index like VOO over VXUS is almost every company in the S&P 500 index is international. Look at McDonald's. McDonald's is on every corner in Europe. In not in every case, like in certain countries more than others, or in Asia, or in Africa, in South America, North America, McDonald's is everywhere. But their accounting, everything is done in the US. The dollar, there's only one currency. So a lot of these companies that are doing business and that are headquartered here in the US actually have a large presence internationally, right? So that's my rationale behind why I prefer US-based companies or US ETFs versus international. Let's take a look at your portfolio. All right, so your portfolio is up over 116%. That is crazy. That is crazy high. Wow. Okay. That in a good way, obviously. You have 23 holdings. You have a 2.3 dividend yield. So highest weighted towards tech, all the way down to energy at 1. Very, very fairly balanced. This is great. I'm excited to look at your portfolio. What do you got in here? You got Microsoft, Broadcom, and Apple. Great companies. Healthcare, you got AbbVie and Johnson & Johnson. I like AbbVie. I really, really like AbbVie. Me personally, I would much feel more comfortable holding a larger position in Johnson & Johnson over 10, 20, 30 years than AbbVie. That's my opinion. Financials, Visa, JP Morgan, they're both great. I really, really like Visa. Visa is great. Real estate, you got AMT and I cannot for the life of me pronounce this, Equinix. I also really like DLR. I also like, I've said this probably the third or fourth time, Prologis. It's an industrial REIT. This would fit really, really well into your portfolio. It's ticker symbol PLD, Prologis. Check it out. Consumer staples, Cisco and Tyson Foods. This is actually very, wow, I'm really surprised actually. I'm surprised that you went with Cisco and Tyson Foods. I get it from the food perspective. It's kind of like the Michael Burry where you're investing into water, you know, the essentials to life. But I think this may be a missed opportunity for you. There's a lot of great consumer staple companies out there. Just to name a few, Procter & Gamble, Pepsi, Coca-Cola, Costco, Walmart. I think there's a lot of great companies in there that I personally would preference or prefer over Cisco and Tyson Foods. Even though I have both of these in my portfolio, I think there's a few others that are a little bit better in my opinion. Materials, you got Sherwin-Williams and Avery. All right, great. I think these are really good materials. I have PPG instead of Sherwin-Williams, but I think Sherwin-Williams, I think it's great. It's kind of like the McDonald's of paint. Industrials, too, you got Lockheed Martin and Illinois Tool Works. Yeah, I like these. I think these are great. I also really like 3M. I like Waste Management, you know, those kind of companies. But I mean, you're really, you know, this is a hyper growth portfolio. You're doing really, really good. Wow. Consumer discretionary, Lowe's and Home Depot. Great. I also like McDonald's and I like Target as well for consumer discretionary. Utilities, Nexair Energy and WEC. Great. Communication services, Comcast and Verizon. Great. You don't have AT&T. You said you're focused more on growth. That makes sense. Energy, you got Chevron and ExxonMobil. Yeah. I mean, it's only 1%. I mean, I don't think you can go wrong. I used to have my portfolio set up exactly this way. Yeah, I think it's fine. So a few closing thoughts. I think you know what you're doing. I think you are right on point, exactly what you're trying to accomplish. So you said you're 33 years old. What I would recommend you do now is if you're really serious about growing cash flow from your dividend growth portfolio, you got to do a couple of things. You got to do three things. First thing you got to do, stay out of debt. Consumer debt. Stay out of debt. Second thing, you got to earn more money. Side hustle. Do other things. Maybe you can work overtime at your job. Maybe you can take up a second job. You can do, you can house hack. You can anything that you can do to generate more income. The third thing that you need to do is you need to cut costs. If you are paying too much for your phone bill, if you're paying too much on your utility bill, if you're paying too much on your insurance, whatever it may be, lower your costs. If you do those three things, you're going to be financially independent. Thank you so much for sending this over. I really appreciate it. All right, let's take a look at the next one. Alan writes, hi, recently I transferred from Betterment. I started my investment from around September 2019. Can you look at my portfolio? With recent volatility in the market, especially in the energy sector, what is your take on it? Overall, I want to be part of the FIRE movement and wondered if it's too late for me. In addition to this, I have a 401k account with my company, but they do not match my contributions. I just started in my 30s and I want another to review my portfolio decisions. Overall, I want to achieve a balance of growth and dividends. I reinvested all of my dividends, but with dividends being taxed annually, I want to minimize my tax liability too. Okay, let's take a look at it. So first off, Alan, thanks for sending this over. It looks like you transferred over from Betterment. The energy sector is, what I've noticed with energy is if you follow my channel, in my most recent portfolio video where I reviewed my portfolio, I recently sold out of energy. I only had ExxonMobil and Chevron. Now, with ExxonMobil and Chevron, I think these are great companies, right? I just personally, the reasoning behind why I sold out of them was for me personally, I didn't want to have to always go to bed every night thinking, okay, when is the day going to come when energy is going to tank another 20%, another 30%? I get exposure to the energy sector through broad-based ETFs like the S&P 500 and so forth. So I still get exposure to energy, but I'm not exposing myself to individual companies. And that's my personal opinion. That's what I've chosen to do. Part of the FIRE movement, so financial independence, retire early. This is a wonderful movement. You know, I'm currently striving for financial independence as well. That's what I talk a lot about on my channel. You say that you're in your 30s, you absolutely can still achieve FIRE in your 30s. You can achieve FIRE in your late 40s, early 50s, right? It's never too late. Obviously, it's always better the sooner that you start, because then you allow time for your investments to compound, right? Like, that's really the advantage that you have with investing earlier. But I don't want it to discourage you. I mean, I'm 34. I'm looking to achieve FIRE, right? So some people, they retire in their 30s. Some people retire in their 40s, 50s. It's all personal, right? And so when looking at the tax, the dividends being taxed, yes, I mean, your dividends are being taxed, but if you do it, this is obviously dependent on your tax bracket, your situation, obviously. For me personally, capital gains tax on my dividends are only 15%. I have the majority of my holdings in qualified dividends. Qualified dividends are taxed much more favorably than ordinary income. So that to me, the 15% is, I'm not fazed by that one bit. Let's take a look at your portfolio. All right, it looks like you have 88 holdings in your portfolio. You're up 50% over the last 5 years, just over 2% dividend yield, expense ratio, pretty small. So you got a few ETFs in here. You have it broken down by equities holding 60%, dividends, technology. So I'm assuming that you broke this up in terms of how you kind of cluster your investments together, right? So you got some in industries, you got some in different asset classes, also different strategies in terms of like dividends. You also talked about growth and dividends. For me, I've shared this in previous videos. When it comes to growth and dividends, if you really want to focus on the two, you could also set up different accounts within M1 Finance. You could have just a growth portfolio and you could have just a dividend portfolio if that helps with setting it up. Kind of just mentally allocating them differently and having different approaches. That's something that you could do. Or hold it in a different brokerage, for example, just an idea. So let's take a look at your equities. Looks like you have 7 in here. You got the Vanguard Total Stock Market Index Fund. This is my favorite ETF. If I could only hold just one ETF, it would be VTI. A close second would be VOO and VIG for me personally. You got VEA, so you got some international exposure here, quite a bit of international exposure. I'm curious of why you went with so much international exposure. A lot of the companies in the S&P 500 are so internationally diverse. You look at McDonald's; they're in almost every country in the world. You don't have the volatility with the currency, right? I personally, I'm a bigger fan of investing into U.S. companies. If you're going to go internationally, I do own one international ETF, but it's only, I think, 10% in the portfolio. I personally, I think you get adequate international exposure through the S&P 500. Almost every company in the S&P 500 has an international presence. That's my opinion. You got small cap, you got mid cap, you got mega cap. So you have it broken down. I think with this, you run the risk of you're going to end up changing and touching your portfolio more the more complex it is. So in my opinion, try to make it as easy as possible, right? You have a lot of different ETFs in here. They all hold a different purpose, but understand that you're going to be tempted throughout the coming years to play around with these percentages, and just be aware the more you touch, the more you change your portfolio, the more diminishing returns you're going to have. It's important to understand that. Your dividends, what do you have in here? You got domestic and international high dividend ETFs, VYM and VIG. All right, great. I'm a big fan of VYM and VIG. I don't personally invest into the international ones, but I mean, you only have 5% allocated here. This is completely fine. Technology, what do you got in here? VGT, great, sector specific. I like this. I actually did something very, very similar, where the majority of my slice in technology is in VGT, and then I have it broken down very, very similarly, actually. Financials, you got some traditional banks in there, Visa and MasterCard. Okay, good. Bonds. Okay, you got some bonds in here. I think, if you're going to hold bonds, I think not having more than 10%, in my opinion, with your age group, the less the better, in my opinion. Real estate, 3%, VNQ, VNQI. So you're really trying to get as diversified as possible, both domestically and internationally. Okay. I guess really my only opinion there is to make your portfolio as simple as possible. Once again, the more you change your portfolio, the more likely you're going to have diminishing returns. So really understand that. The remaining slices in here, you got industrials. Oh, that's cool. I like to see that you got WM and RSG in there as well. I also like 3M and companies like that. Lockheed Martin is also good. Utilities, VPU. All right, good. Yeah, I mean, so it seems like you have a firm grasp on what you're trying to do. I can tell right off the bat that you put a lot of effort into your portfolio. The thing that I like about this is you're doing this yourself. You're not handing this over to a financial advisor and say, hey, do this for me, I'm not interested. I think what you're going to, over time, as you continue to educate yourself and learn more about investing and really you mentioned you're following the FIRE movement. As you learn more about the FIRE movement, it really talks about simplicity, really making your portfolio as simple as possible. The whole idea about the FIRE movement is so that you're financially independent. You don't want to be focused. You don't want to turn your investments into a second job, right? And so that would be my advice there is think about how you can simplify your portfolio so that you don't have to go to bed at night thinking about, okay, is it too complex? Is it not complex enough? Try to make it as simple as possible. But Alan, thank you so much for sending this over. I really appreciate it, and I wish you all the best. All right, let's take a look at the next one here. The next one is from CJ. I've led your concept of portfolio reviews so far and was wondering if you had any input on mine. Well, CJ, thank you so much for saying that. I appreciate that. First off, I've just started learning about dividend investing, so I'm trying to gain knowledge before I throw a lot of money towards it. Right now, I'm only able to invest about $300 to $600 a month. I'm 23 and I'm a recent grad equipped with a biology degree. The goal of my portfolio is to create a reliable passive form of income without all the maintenance. Great, I love it. All right, he also throws in here, usually my bond percentage would be around 10%. Okay, let's take a look at your portfolio. All right, CJ, so you're up about 72% over the last 5 years. You don't have any ETFs. You have a really good dividend yield, over almost 4%. You have just 28 holdings in here. You have it broken down, healthcare at 20%, real estate at 15%, tech at 12%, consumer at 12%, utilities 10%, telecom 10%, finance 10%, industrials 5%, energy at 5%. Okay, so you're 23 years old. I think you're 23 years old. You didn't say the time frame in which you're trying to retire. I know some people that are trying to retire by the time they're 30 years old. I know some people that are trying to retire in 20 years. Everybody's time frame is a little bit different. So for this purpose, I'm going to make the assumption that you're going to try to retire by the age of 40. Okay. I'm just going to try to make the assumption as basic as possible. So you have 17 years to invest. You're going to look to retire by the time that you're 40 years old. So in your first one, it's going to be healthcare at 20%. You're invested in Johnson & Johnson, United Healthcare, and Merck. Great. I think these are great, high quality dividend growth companies. Okay, let's take a look at real estate. Real estate, you have 4 holdings in here, a whopping 8.5% dividend yield. You have Realty Income, MPW, NRZ, and APTS. So I think if you're 23 years old, I definitely like seeing Realty Income in here. This is a great monthly dividend payer. I would like to see, in my opinion, if you're investing for the next 17 years, I would like to see more hyper growth REITs in here. For example, my favorites, Crown Castle, AMT, ticker symbol AMT in the cell towers, DLR for data centers. I really like Prologis for industrials. Those type of investments that are growing their dividend much quicker. I think you're going to have better long-term results given your age. So that's my opinion. Technology, you have 2 in here. You have Apple and Microsoft. Very simple, very straightforward. I like it. Consumers, you got Disney, Procter & Gamble, Home Depot, and Starbucks. Yeah, I mean, these are great. I'm looking at this here. So in times of economic turmoil, you're going to have a little bit of fluctuation, although Procter & Gamble is a great recession-proof stock. Yeah, I think this is actually fine. Utilities, you got three in here: Dominion, NextEra Energy, and Southern Company. Yeah, I mean, this is good. I also like Duke as well. NextEra Energy, I personally would, given your age, I would bump up NextEra Energy personally. Telecom, you got AT&T and Verizon. Great, both in my portfolio. If you wanted to look at another one, you could look at Comcast. Finance, you got Visa, Main Street, JP Morgan, Aflac. These are great. You know your stuff. This is really good. You're 23 years old and you got a portfolio like this. Wow, it's impressive. Industrials, Union Pacific Waste Management. Two others that I really like. I really like 3M. I really like a couple of them. There's a lot of industrials I like. I like Honeywell. I like Lockheed Martin. A lot of these companies, with great track records in the industrial sector, I really like. Energy, 5%, Exxon and Chevron. This is fine. I think 5% is a little bit high. Like, in all honesty, I would bump this down to maybe 1 or 2%. And then bump up technology to maybe 15%, like say 15% technology and 2% in energy, in my opinion. And then bonds, 1%. To be honest with you, I don't think you really need any bonds. You're 23 years old. The only reason why you would want to have bonds is, yes, the psychological benefit that comes with investing into bonds. But the only reason why you would even consider, I guess, in my opinion, having bonds is to rebalance, right? When the portfolio goes down, 30+%, then you rebalance, you sell out of the bonds and you buy into equities. Like, that's the only reason that I can see holding bonds at 23. Otherwise, even at 1%, like you could take that 1% and you could put it into technology, and that would serve you better over a 17-year time period. All right, well, thank you so much for sending this over. I really like your portfolio. I like it a lot. All right, let's take a look at the next one here. Kenny writes, "Hello, Jacob. I want to start by saying I really enjoy your videos." Thank you, Kenny. I appreciate that. They've all educated me, so thank you so much for putting in the time and effort to help all of us with investing. I currently hold an M1 Finance account with the goal of dividend growth investing to either retire early or at least supplement my income in retirement. I'm 22 years old and plan to invest at least $300 to $400 a month into my taxable account. I plan to invest more per month as my income increases. I have been investing for about 7 months so far. I finally feel like I have solidified my holdings for the most part and enjoy having a lower amount of holdings compared to some portfolios I have seen. Currently, I hold 28 positions, with a couple of them being ETFs. Thank you again for what you do. I appreciate any feedback. Well, Kenny, thank you so much for sending this over. Alrighty, Kenny, well, let's take a look at your portfolio. So you're up over 85% over the last 5 years. You have a very low expense ratio, a good healthy dividend of 3%, and 28 holdings. So you're going for quality over quantity. I really like it. So let's take a look at it. Your allocation, 20% in technology, 5% in energy. That's exactly right. You could even lower energy even more if you wanted. You have a lot of time. You're in your early 20s. You have a lot of time for your dividends to compound. It would even be advisable to, in my opinion, to lower that and, increase, for example, your technology sector. So what do you got here? Technology, you got Microsoft and Apple, great high quality companies. I really like it. Real estate, you got Realty Income, VNQ, and DLR. I love to see DLR in there. Realty Income is good. I mean, it's not a really hyper growth ETF. They grow their dividend, I think, less than 5% a year. So the benefit of Realty Income in this portfolio is you're getting that monthly cash flow, and it's going to help with M1 Finance. It's going to help fund your other holdings in your portfolio. That's one thing that I love about M1 Finance. Whereas if you had it in a different brokerage, it would just get reinvested, and you could take it off and take off the reinvestment, but then you'd have to manually go and reinvest the dividend. With M1 Finance, it's all automated, and that's what I absolutely love about it. So you got DLR, you got VNQ. You could take a look at AMT, cell towers. You could look at other data centers, or industrials. I really like PLD, ticker symbol PLD. Utilities, let's see what you got in here. You got Dominion, Duke, American Waterworks. These are great. These are great. These are high quality. I don't know if you necessarily need 10%. 10% is pretty high. I mean, you're in your early 20s. I don't know if you necessarily need utilities so high, in my opinion. Telecom, you got AT&T and Verizon. Okay, it's good. Industrials, you got Waste Management, Honeywell, Emerson Electric, and 3M. Okay, so these are really good. You got Waste Management, Honeywell. So Emerson is a dividend king. They grow their dividend a little bit slower, but these are really, really high quality. These are really high quality. So you got to mix. So Honeywell, they're growing their dividend over 10% a year. 3M is growing their dividend over 10% a year. Waste Management is a little bit less than 10. I really like Waste Management because for me personally, I can wrap my head around Waste Management. I know exactly what Waste Management does. They have a consumer-facing business. They have a commercial-facing business. And yeah, it's just one of those companies I'm willing to sacrifice a little bit lower growth because I know exactly what this company is going to be doing in 20 years from now. Yeah, so you got Johnson & Johnson, AbbVie, Pfizer. These are really good. I mean, Johnson & Johnson here is by far my favorite. Financials, VFH, this is really, really good. I like to see this. I like seeing Visa and JP Morgan. I have my portfolio set up in a similar way where I have a large portion in my financial sector allocated to the sector-specific ETF. All right, let's take a look at your consumers. It looks like you have consumer staples and consumer discretionary in here. Pepsi, Procter & Gamble. These are great companies. These are really great companies. These are high quality, large cap companies. All these companies are going to be around in 20, 30 years. You're doing really good. Energy, you got ExxonMobil and Chevron. If I like both of these. I used to have these in my portfolio. If you follow my channel, you know that I recently sold out of these. It's not that I thought that they're not going to do well in the near or short term. I mean, you can see that they're bouncing back up. So Kenny, I think your portfolio is great. I really like the fact that you have a plan. You know what you're trying to accomplish. And I think the only thing that you could consider is looking at the target allocation. Utilities, not so much a hyper growth sector. You're in your early 20s. I think you could, and this is just my opinion, right? Maybe consider bumping up your industrials, your consumers. You could even bump up technology a little bit more. You're in your early 20s. I don't know. I mean, you could consider doing that. But as a whole, as it stands, it's a great looking portfolio. I think you're off to a really, really great start. All I can say is I wish I was in your shoes when I was 22. So great job. All right, let's take a look at the last portfolio here. Ven writes, hi, great content, subscribe to your channel. Hey, thank you so much. I appreciate it. I'm trying to create my ETF portfolio using M1 Finance. The dividend yield is different than the actual yield. Like my total ETF portfolio yield is close to 4%, but M1 says it's around 3%. Can you please let me know why this is doing this? Yeah, so the reason why this is doing that is it's not updating in real time. It usually takes about a day or so for M1 Finance to update the actual dividend yield because prices are always fluctuating. If you go to Google or Yahoo.com, you go to any site, in most cases, they're not in real time. The dividend yield is not in real time because the prices are during at least market hours, they're fluctuating. What I've noticed, if you're using M1 Finance, if you go to the research tab and you take a look under your pie and you see the dividend yield, the most reliable yield that I've noticed is on Sunday. When you look at it on Sunday, that's your actual yield. That's when it's updated fully. I think Saturday and Sunday, that's when the yields are most current. All right, let's take a look at the last portfolio here. You're up 42% over the last 5 years. You have a small expense ratio, just under a 3% dividend yield. You have 10 holdings. Looks like the majority of them are from Vanguard, allocated all the way from 47 to 1. Okay, so you got 60% in VOO and VTI. That's great. I think the fact that you're focusing on quality is really, really important. One thing that I would note, it looks like you have it broken down into smaller pieces. This might, for you, this means proper diversification. Proper diversification can mean something different for every person. My only piece of advice here is with a Roth IRA, you mentioned that it was a Roth IRA in another email, that main thing with that is you want to set it up and forget about it. Automate it as much as possible and then just don't touch it. With your target allocation here, I would encourage you to make it as simple as possible and then just forget about it. And just let it grow in the background and focus on other aspects of your life of cutting your expenses and side hustling, getting other sources of income so that you can reach financial independence, if that may be your goal. For example, that's what or getting out of debt, right? So thank you so much for sending over your portfolio. Thank you everybody for sending over your portfolio. I really appreciate it. Thank you so much for, adding context to who you are. I really enjoy this series. I really enjoy seeing other, subscriber portfolios. I know that these videos are a little bit longer. I can hear it in my voice. I'm already starting to lose my voice. Thank you so much everybody for the support. If you'd like me to review your portfolio in a future video, shoot me over an email. I'll leave an email in the description below. Give a little bit of context so I know who you are, kind of your age, your goals, how much you're funding the account, all that good stuff, and I'll do my best to review in a future video. If you're new to the channel, I'd invite you to subscribe, like the video, and I'll catch everybody in the next video.